The market is looking for another stellar quarter for Goldman, with estimated EPS doubling to more than $4 a share. Citigroup, however, seen posting yet another loss. So joining us now with a preview is Ralph Silva. He is research director at Tower Group in London. Good morning, Ralph. And let's start with the fact that JP Morgan set the tone for bank earnings yesterday, rightly or wrongly. And the story seems to be strong fixed income trading and losses on consumer loans. In that light, how will Goldman and Citigroup stack up?
Well, I think if you look at what happened with JP Morgan, we can safely assume that Citi's probably going to lose some money. And the reason they're going to lose some money is the retail banking activities and the loan losses and the credit card business. It's just there's too much pressure in that environment right now. Goldman, on the other hand, is probably going to do incredibly well because they're the first stop for every new business deal that's been going on in the past 12 to 18 months. And they basically have their first right of refusal, and they've got the best deals, and they're going to do very, very well. Yeah,
the consolidation of the industry is certainly benefiting Goldman Sachs. Now, can the fixed income trading momentum continue over at Goldman Sachs?
It can, simply because we're seeing a consolidation within that environment as well. And of course, many people who want that kind of business are gravitating towards Goldman because the other companies in that business are basically reducing their capacity where Goldman's actually increasing their capacity. This is all about a capacity and how much capability the banks have. Citi simply has too much capacity, and it costs them a lot in infrastructure costs. I like to say it's like using an 18-wheeler to transport an iPod in the case of Citibank, and that's one of the reasons why they're suffering so much.
Now, Goldman lost its top position in M&A advice this year. Do you expect to see that show up in their revenue?
Yes, but it's going to be a very small component of the revenue, and the reason for that is that they've had so much new business. M&A activity has increased over the past 4 or 5 months. It's actually exponentially increased. We have a lot of new deals. I suspect they're all in their infancy, so we're not going to see huge amounts coming through there, but enough to keep all their people busy. As a result, they're going to be profitable for that reason. And perhaps later on in the year as well.
Now, what about Goldman's value at risk? A lot of people looking at that lately, and it's been climbing.
Yes, it has, and actually it's been climbing for most of the banks, and the reason for that is that there's still this perception that we're going to get out of this economic downturn very, very quickly, and I think that that's probably not a valid assumption. I think we're going to see a fairly slower, gradual climb from this point on, and they've taken on an enormous burden, an enormous risk burden, if this economy continues to be depressed for the next 6 to 8 months, which we suspect will happen.
Let's take a look at Citigroup, because it got rid of Fibro, the commodities trading unit, and Andrew Hall, for that matter, earlier this month. But it's been pretty slow to shed assets, to shed non-core businesses, as promised, in fact. Now, how much longer do you think investors are willing to be patient with Citigroup?
Well, I'm surprised they've been as patient as they have been, because it's just simply taken them too long. They've had 2 years to shed some of these assets, and they just haven't moved forward. There's this impression in the senior management of Citi that this economy is going to come back and that customers are going to start banging on their doors. And, you know, if that happens in the next 2 or 3 days, that might be a possibility, but it's not going to happen. And as a result, they have way too much going on. They're not being as aggressive as possible. We see companies like ING, UBS, we see all the big banks doing it much, much more quickly than they are. And I think investors, they should be yelling and asking why this isn't happening as quickly as it is.
So would we say that it's Vikram Pandit's fault?
Well, I think it's all senior management, so I don't want to focus on one particular individual, because it's, especially Citi is a very political organization. But the truth is that there's a lot of constituents there, and they all want and they all believe that the economy is going to change in their particular area, and they're fighting with each other instead of selling off assets.
All right. Thank you so much for your thoughts. We've been speaking with Ralph Silva of Tower Group in London.